And we've also seen high inflation, recessionary fears, and the war in Ukraine, all of which we're still dealing with in 2023. And yet, through all this, people continue to travel. And 2022 was a record year for Airbnb. Revenue of $8.4 billion grew 40% year over year. And when you exclude foreign exchange, our revenue increased by 46% year over year. Net income was $1.9 billion, which marks 2022 as our first profitable year, full year, on a GAAP basis. And finally, free cash flow was $3.4 billion. And this $3.4 billion free cash flow represented a free cash flow margin of over 40%. Because of our strong balance sheet, we were able to begin buying back stock last year, and we repurchased $1.5 billion in shares in just the past 5 months. Now, during the height of the pandemic, we made some very difficult choices to reduce our spending, making us a leaner and more focused company. And we've kept this discipline ever since. And over each of the past 2 years, we've only modestly increased our headcount. In fact, compared to 2019, our headcount is actually down 5%, while our revenue is up 75%. And every single quarter in 2022 outperformed past comparable periods. In Q4, net income was $319 million. Now, this is $264 million higher than a year ago. Adjusted EBITDA was $506 million, which is 52% higher than Q4 of 2021. And we generated $455 million free cash flow, and this is 20% higher than Q4 2021. During the quarter, we saw a number of positive business trends. First, guest demand on Airbnb remains strong. Nights and experiences booked increased 20% in Q4. We had our highest number of active bookers ever in Q4, demonstrating guests' excitement to travel on Airbnb despite evolving macroeconomic uncertainties. During the quarter, we also continued to see guests booking trips further in advance, supporting a strong backlog for Q1. Second, guests are increasingly returning to cities and crossing border. And this is the bread and butter of Airbnb before the pandemic. Now, both segments continue to accelerate, while non-urban and domestic travel remains strong. Cross-border gross nights booked increased 49% compared to last year. High-density urban nights grew 22%. And globally, we saw cross-border travel to all regions increase despite continued foreign currency volatility. Third, guests continue to book longer stays on Airbnb. During Q4, long-term stays remained stable from a year ago at 21% of total gross nights booked on Airbnb. And finally, we saw tremendous growth in our supply on Airbnb. We ended 2022 with 6.6 million active listings. Now, excluding all the mainland China listings we removed in July, we grew supply by 900,000 listings, or 16% compared to a year ago, representing an acceleration in growth in listings relative to Q3. Now, why are listings accelerating in growth? We believe there's probably 2 factors that drove this growth. First, demand drives supply. Hosts are attracted to supplemental income that they can earn on Airbnb, which is often critical during tough times. Second, our product improvements are working. Over the past 2 years, we've made it more attractive and easier to become a host. Just this past November, we introduced Airbnb Setup, where prospective hosts can connect with Superhosts for free one-to-one guidance all the way through their first reservation. The number of new active hosts recruited with the help of our Superhosts increased by more than 20% compared to pre-launch. But we are not stopping there. In 2023, we're focused on 3 strategic priorities. First, we want to make hosting mainstream. If you're listening to this call, you've likely traveled on Airbnb or you know someone who has. We want hosting on Airbnb to be just as popular. And to achieve this, we'll continue to raise awareness around hosting, make it easier to get started, and provide even better tools for hosts. Second, we are perfecting our core service. We want people to love our service. And that means obsessing over every single detail. And we've listened to our hosts and guests, and based on their feedback, we're making a large number of upgrades to our service this year, including improving customer service, making it easier to find the right home, and delivering greater value, and much, much more. And you'll see more of this in the coming months, especially our summer release. And finally, third, we're expanding beyond the core. We have some pretty big ideas for where to take Airbnb next. And this year, we're going to build the foundation for future products and services that will provide incremental growth for many years to come. So with that, Dave and I look forward to answering your questions.
Thank you. If you would like to ask a question, press star followed by the number 1 on your telephone keypad. We ask today that you limit yourself to one question and one follow-up. Thank you. We'll pause for just a moment to compile the Q&A roster. Your first question today comes from the line of Jed Kelly with Oppenheimer. Your line is now open.
Hey, great. Thanks for taking my questions. Great quarter and great execution. Two, if I may. Just one, can you talk about how your urban supply is trending and sort of some of the initiatives you're doing around apartments? And then Brian, you did mention, headcount. In Silicon Valley, there's obviously a lot of layoffs. You're one of the companies that are growing, having expanding margins. So can you talk about your ability to attract top tech talent to execute on some of the initiatives you just talked about? Thank you.
Yeah, absolutely. So let's start with the first one, urban supply growth. Let me kind of first start, Jed, by just talking a little bit more about how we think about supply. The great thing about our supply is that the vast majority of hosts that come to Airbnb come organically, and that's because of our global network. In fact, the number one source of hosts are prior guests. And in Q4, 36% of our hosts were prior guests. And one of the other things we see is the fastest growing markets where we have supply is also the fastest growing markets where we have demand. And I think what's happening is a lot of our hosts are regular people. And as they get more bookings, they tend to tell their friends. And so this network is something that has a kind of self-growing effect to it. Now, in addition to that, we've been doing a number of initiatives. Number one, we've been focused to make hosting easier with Airbnb Setup. And between that and a new campaign we've been running, Jed, called Airbnb It, which is basically this idea that if you have a space, you have an Airbnb. Between these two initiatives, we've seen twice the amount of traffic to our host landing page. This is a landing page to learn about hosting. And then we also have made big improvements to making hosting easier. Now, in addition, you might have seen that last November, we announced a new initiative called Airbnb Friendly Apartments. Airbnb Friendly Apartments, I think, can unlock a large amount of inventory in multifamily homes in urban areas. And we worked with Greystar and a number of the other largest real estate developers in the United States. We have 175 buildings in Phoenix and Jacksonville and Houston and other cities. And the response from landlords has been very, very positive. So we are seeing a lot of traction on urban supply. I don't know, Dave, if you want to add anything before I talk about headcount.
Yeah, you covered it really well, because this has been historic strength of ours, has been kind of the urban part of the business. It's taken longer for that to kind of recover. It's now well above 2019 rates, and it's actually part of the areas that accelerated our growth in the Q4. So we're very happy with where we're at with urban. And as Brian said, the early days of Airbnb Friendly Apartments has been very well adopted, and we're excited about the potential of that part of the business.
And just on your question, Jed, on headcount, something was really interesting happened. So obviously in 2020, we had to make some really difficult decisions, and we became a much smaller and more focused company. And the obvious result of that is that we got more efficient and more profitable. But there was a less obvious result. What ended up happening is we had fewer people in meetings, and people can move a lot faster. And we concentrated all of our very best people and put them on only a few problems. And I think that's been an explanation for why the company's grown really quickly. But also, I think it's made us a much more attractive place to work, because it's much easier to get work done. And we have a general philosophy that we want the very best people in every field to come to Airbnb in every function. We're functionally organized. And I think that, we're one of the few tech companies that isn't, doing layoffs. We're not cutting, we're not freezing. we're actually stepping on the gas. But in our mind, stepping on the gas doesn't mean adding a huge amount of people. We're going to continue to stay really lean, but we're really focused on just really hiring in key positions. And again, I kind of use this analogy that we're not building like a giant navy. It's more like the special forces. That's what we're focused on. So we've had a lot of success with talent, and of course, we're getting a lot of inbound.
Thank you. I'd add a couple things. One is, our headcount is actually still 5% below where it was in 2019. And yet our revenue is 75% higher. So we're nearly twice as big as we were previously with fewer people. And I'd say another is our live and work anywhere approach, our approach to being very intentional about how we gather in person. We believe that actually working together in person is very important, just need to do it in a very coordinated way. So actually having people being back in the office on random days of the week is not very effective, but doing it in a very controlled and planful way is respectful of employees' time and is more efficient for the company. And our employees love it. And I think that's also enabling us to attract great talent.
Thank you.
Your next question comes from the line of Richard Clark with Sanford C. Bernstein. Your line is now open.
Hi there. Yes, thanks for taking my questions. Two if I may. The first one just around, I guess, some of the changes that might come over the coming years with regard to the distribution landscape. One of your rivals is going to wrap their vacation rental business into a loyalty program. Lots of talk around conversational AI and what that can do to the distribution landscape. So just any comments whether Airbnb needs to do anything further on the distribution platform. And then second one, a little bit more prosaic, but obviously it looks like Q4 was a very good quarter for take rate. Have you done anything particular there on take rate to achieve that result? Thank you.
Dave, you want to start with take rate, and I'll end with distribution platform?
Yeah, with take rate, there's nothing in particular that we've done with take rate. The absolute, on a time-adjusted basis, the amount that we take from each night stay has been very stable. And so any variation in take rate of revenue over gross booking value is just variation quarter to quarter. So nothing on take rate.
And maybe, Richard, just if I can you just clarify what you mean by distribution landscape? Do you mean like the competitive environment or how we get demand?
The competitive landscape, competitive environment with regard to distribution, whether you see any threat or increased threat from a loyalty program wrapping around your competitors and maybe the conversational AI that's coming into various other search platforms at the moment.
No, I mean, like, I think there's just two things. On the competitive front, I mean, we have a lot of competitors in a lot of different categories, but I think Airbnb kind of stands in a class of its own. I mean, we're a noun and a verb used all over the world. We're not just a US business. We're not just a European business. We're a global business. We're not just vacation rentals. We're also urban and cross-border and off the grid. We're known as an affordable way to travel, but we also have a luxe offering and everything in between. So, I think we have a pretty unique offering. And I think ultimately, 90% of our traffic comes direct. And that's because we have something that's unique. The vast majority of our homes don't exist anywhere else. And what we're really just focused on doing is we're obsessing over providing the very best experience for guests. And if we do that and we perfect that experience and then we do really great marketing, I think we'll do quite well. The only other thing I'll say, Richard, on the distribution front is we have some unique assets that most other travel brands don't have. Let's take PR. There were 600,000 articles written about Airbnb last year. Airbnb is on social media a lot, and a lot of people are talking about Airbnb on social media. So we generally have a slightly different approach to distribution, where we think just continually innovating on our product is great. The best loyalty program is building a product people love so much they want to come back, and you don't have to pay them to come back. And we just take a full funnel approach to marketing around, PR. And we think of our general advertising as really educating people on new products. Now, as far as the changing landscape for technology, I'm actually very excited about the possibilities of AI. I think Airbnb will uniquely benefit from this. And the reason why is because Airbnb is a fairly difficult product challenge, which is unlike hotels, we don't have SKUs. There's no representative inventory. Every single one of our 6.6 million listings are unique. Guests left more than 100 million reviews last year. And to parse through all these reviews is very laborious. And I think that AI is going to really benefit our long tail of data. and the fact that our search problem isn't really a search problem so much as a matching problem, right? If there's like 50,000 homes in a city, what's the right one for you? That's less of a search problem than a matching problem. And I think that AI is going to be a really great opportunity for us. And just stay tuned for some developments there.
That's great. Thanks very much.
Your next question comes from the line of Ron Josey with Citi. Your line is now open.
Great. Thanks for taking the question. Brian, you mentioned, investments for 2023 and expanding beyond the core. That's been a key question that we consistently get in terms of what's next. And any insights you can provide there would be helpful. Maybe just is it building out the tech infrastructure, or is it more sort of newer products that are coming down the pike? And then I believe in the letter we talked about 1.4 billion cumulative guest arrivals. And so I was wondering if you can talk more about the brand, the awareness overall, and just that user mix in terms of returning users versus newer users. Thank you.
Yeah, awesome. Well, let me start with investments for 2023. So the good news is that though we're investing this year in some new products and services to expand beyond the core, I don't think you're going to see any material changes to the P&L. We kind of think, like I started Airbnb with my two friends. We didn't have very many resources back then. And the great thing about Airbnb's business is we're essentially a global network. So I think that we can incubate new opportunities, products, and services for relatively low amount of investment. And as far as what you're going to see, I'd say there's going to be innovations on the guest and host side. On the host side, our general principle is that we want to always deliver more value for hosts than we're charging. And we have a 3% take rate on the host side. And we've been giving away a lot of products for free, like AirCover. And we launched AirCover for hosts 2 Novembers ago. NPS for claims, reimbursement claims, has gone up 70 points. So it's been pretty amazing. And our general view on hosts are we're going to primarily give away most of our products, services, and innovations to them. But we do think there's some opportunities for ecosystem of services that hosts might pay for. On the guest side, we started very modestly. You might have seen that we launched travel insurance, which is now in 8 countries, and that's been really, really successful. But I think there's many more opportunities around the services. Obviously Airbnb experiences is something that we're beginning to really ramp up, and I think you're going to see a lot more traction in that product in the coming years. And I think there's going to be just a lot more around creating a step change in new service level and matching people to the right homes and experiences for them. So that's what I would say. Services on the host side, services on the guest side. There's going to be a lot of opportunities to revisit some of the end-to-end travel opportunities that we have, and you'll stay tuned for some cool innovations. Oh, and sorry, on the brand awareness, brand awareness. On the brand awareness, again, we generally try to, as I said the last part, we generally focus on a full funnel approach. 90% of our traffic is now direct. It's sustained that since we went public. It's always been about 90%. We have extremely high efficiency on things like performance marketing. And generally, the way we approach our brand is that Airbnb is a pretty ubiquitous brand. So what we really want to do now is continue to invest in awareness around our different innovations. And they're going to be 2 things. Number one, we're going to be focused on educating people on our new services and offerings. So, for example, Airbnb categories, we've been running campaigns around that, and people have viewed 500 million. People viewed listings 500 million times through Airbnb categories. We're also continuing to raise awareness around hosting. We're going to grow as fast as we have hosts. Now, as far as how much traffic is coming from new returning, I don't know if Dave, you want to share anything about that, or where our brand is.
Yeah, I mean, the majority of our bookings come from past guests, and it's actually been the strong guest retention that we've had over years since the beginning of Airbnb that's been a powerful driver of our growth. But I think what's also interesting is that we've introduced Airbnb to millions of new users since COVID, and the performance of those new users, the booking frequency of those new users from 21 that we saw into 22 has been very strong. And so really pleased with the new users that we've been able to attract that look very, very similar to the historic type of users that we've had on Airbnb.
Great. Thank you, Brian. Thank you, Dave.
You're welcome.
Your next question comes from the line of Mark Mahaney with Evercore. Your line is now open.
Okay, two questions, please. I know you mentioned that guest to host ratio. I think you said something like 36% or something. I imagine you've got cohort data that shows that the percentage of guests that have converted into being hosts or additionally are hosts is actually higher, maybe much higher. Could you just qualify that or quantify that at all? I'm sure that's a pipeline, but just how robust is that pipeline when you look at the cohort data? And then just very briefly on China, just on the China outbound, can you just remind us how material that was to your business back back in 2019, so we can get a sense of. I know you've said that the China outbound market will gradually reopen, but as it fully reopens, how much of an opportunity that is for you? Thank you.
Yeah, I mean, I'll start, Mark. Yeah, we've seen that in Q4 2022, 36% of new available hosts who started out as guests in Airbnb. This is more than prior years, so this has been going up actually like year over year. So that number is going up, and it kind of makes sense as Airbnb becomes more ubiquitous. But also it makes sense because a lot of people, they'll connect with a host and they realize, wow, I could do this too. And the vast majority of our new listings are by individuals, not property managers. So there's this kind of interesting network effect where guests become hosts and then hosts become guests. As far as China, we expect the recovery to be pretty gradual in China. We think the big prize in China is the outbound business. We think that there are going to be hundreds of millions of people that want to leave China to travel the world, and we think Airbnb is going to be the best way for essentially Gen Z people to travel. I think they really want an authentic experience when they're traveling around the world. That being said, we are expecting a pretty gradual recovery in China.
And China, kind of pre-COVID, was in the kind of low single-digit percentage of our gross booking value. So it gives you some perspective of our opportunity. We think could be large over an extended period of time, but it will take a while for it to be larger.
And Mark,
Thanks,
one other
Dave.
thing is just one other thing is, you are right that the cohorts are trending up. So, for example, I think in Q4 2021, 33% of guests became hosts. In 2020, 28%. In 2019, 23%. So it is ticking up.
Yes, that's good. That's cool. All right, thank you.
Yeah.
Your next question comes from the line of Brian Nowak with Morgan Stanley. Your line is now open.
Great. Thanks for taking my questions. I have two. Just the first one, and this is, I'll talk about guests and hosts. Could you just sort of help us understand a little bit, how fast did your new guests grow in 2022? And how are you thinking about sort of new guest growth in 23 as you sort of talk about EBITDA margins, or what's your first cut at how fast guests could grow this year? And then the second one, just any update on metrics or quantifying adoption around I'm Flexible or any of the other tools that you've rolled out to sort of better improve the load balancing between supply and demand?
Great. Yeah, Dave, you want to?
Yeah. No, sure. On the new guests, we don't disclose the exact number of the new guest growth. Like I said, I think the thing that I'm really pleased is that we've introduced Airbnb to millions of new guests since COVID, and that they're performing similarly, if not even stronger than kind of historic guests in terms of their rebooking rates. So I feel really good about the position we have for new guests. A big piece of it is some of the brand marketing that Brian kind of mentioned earlier, is just making sure we have a lot of awareness of Airbnb, but just to also make sure that we're getting strong consideration of Airbnb as a true option for them. And again, in this last several years, we've been able to introduce Airbnb to millions of new people that might not have thought about trying us before. So I think that's been really helpful. And don't have a lot to say on I'm Flexible, except that we have very strong adoption of the feature, and we think that it's a great way for us to distribute demand to where we have supply. And the flexibility features are a key benefit for Airbnb, because we have this more difficult problem that Brian mentioned earlier of matching and trying to match the right guest to the right host. And the I'm Flexible gives us the ability to do a better matching.
Yeah, and one of the things I'll just say, Brian, is that we've seen a permanent shift in some of the travel booking behaviors on Airbnb since before the pandemic, and a lot of those changes have endured. And probably one of the most pronounced ones is incremental flexibility for people. We notice more people are searching with more locations and using more flexibility features. And even before we built these features, we were seeing people entering a lot of different date variations when they were searching. And so we were just really responding to where things are going. And I think where this goes down the road is there's always going to be business travelers and families that know exactly where they want to go and when they want to go. But I think the long-term game here is increasingly, we're in 100,000 markets. People have not heard of 100,000 places. So the name of the game is pointing demand to where we have available supply. And that's kind of a big part of our product strategy.
Great. Thank you both.
Your next question comes from the line of Lee Horowitz with Deutsche Bank. Your line is now open.
Great, thanks. So maybe on ADRs, you guys continue to surpass expectations with FX neutral growth that probably came in the quarter at a mid-single digits up year on year. Well, we appreciate that looking at the 23 pricing initiatives and mix will impact your ability to grow. But we've seen underlying pricing continue to offset these mix impacts. So when you think about 2023, why can't ADRs grow again, given the strength of the overall industry is supportive of pricing for you guys?
Yeah, thanks on the ADRs. We were pleasantly, there's two edges of the ADR. ADRs were up 5% year over year in Q4, excluding the impact of foreign exchange. Obviously, foreign exchange brings it down to kind of minus 1% when you bring back nights that come, say, from Euro or GBP denominated nights. And what we forecasted for the going forward is modest decline year over year in ADRs, largely driven by changes in mix, right? People going back to cities, cities are accelerating, more cross-border travel, mix towards lower ADR regions. It's a double-edged sword. Clearly for the financials, it's helpful to have the higher ADR rates because they drive greater revenue, greater flow through, and greater profitability. But obviously also ADRs are 36% higher than they were in 2019. So it's more expensive for guests to stay on Airbnb and frankly other places. I think the benefit that we've had is that even while ADRs are higher, we're providing great value, right? The ADRs, on Airbnb still can provide a great location, maybe a fully stocked kitchen, a washer and dryer, all the reasons why you might want to stay in Airbnb versus other alternatives. And so as we look forward in the year, we just want to make sure that we continue to provide great value to our guests. And that's why we're building some of the tools that Brian's talked about, which are things like giving tools to hosts to make sure that they understand the prices that guests are paying and making sure that they are continue to provide great value to guests. So then the other thing we're doing is even as ADRs might come down modestly through the year largely through mix, and maybe some through pricing, it's just making sure that we're being really rigorous in our cost structure to kind of support declining ADRs, which is why we anticipate our EBITDA margins for the full year to be roughly the same as 2022, in that the headwinds from lower ADR rates will be offset by our efficiencies that we kind of drive internally.
Great, thanks, helpful. And maybe one follow-up on supply, if I could. Clearly, the product initiatives are driving impressive supply growth, as evidenced by the accelerated rates that you guys are showing at this point. When I think about how that plays through into 2023, is there anything that we should be thinking about that can keep you from maintaining at these elevated rates? Particularly given the fact that you will continue to iterate on the supply funnel to make it easier for hosts to come to the platform.
Yeah, very proud of the continued growth in our supply, and we highlight it in the letter because it's super important that we do our best to have a balanced marketplace, right? If we get too much supply too quickly, then hosts aren't happy because they're not getting enough bookings. If we don't get enough supply early enough, then guests are not happy because they don't get the kind of selection they want. And actually, what we highlight in the letter is that we have grown our supply by 26% since 2019. And yet our nights and experiences booked have grown by 24%. So we've actually had a nice balance in that. And then, I'm very proud of the fact that we've had 6.6 million active listings here in the last year and 900,000 more from the beginning of the year, which just shows the strength of Airbnb and why hosts want to come to where there is demand. And then we're just making it easier for hosts to become hosts on Airbnb. So this will be a forever journey for us to keep providing supply where there is demand. And I think we've been doing it incredibly well for the last, 10, 12 years, and we'll continue to do that.
Yeah, I think Lee, I'll just say, I think we're building a bit more of a muscle too around this. And I think it's been a really big focus of ours. So, whether it's the product innovations, the awareness, focusing on even building supply in key markets, I think it's been a really great muscle the team has built.
Understood. Thank you.
Your next question comes from the line of John Colantuoni with Jefferies. Your line is now open.
Hey, thanks for taking my questions. Wanted to start with the new pricing and discounting tools that you're rolling out. It sounds like the expectation is that they're going to be sort of a net headwind to ADR. So can you just walk through the strategic rationale for the new products? I assume it's about sort of improved customer experience, but it would be great to get your perspective on that. And second, nights and experiences on a quarter-on-quarter basis in 4Q and 1Q seem to be back on trend with the historical seasonality we saw pre-pandemic. Is this sort of the right way to think about the trend in nights and experiences throughout the cadence of the year? Thanks.
All right. Hey, John, I'll start. On pricing and discounts, let's just take a step back. Airbnb, we started 15 years ago. And when we started as an affordable alternative to hotels. And I think that affordability and great value is one of the key reasons that people use Airbnb. And we have to continue to make sure that we have that value. And as long as people feel like they have the best product at the best value for Airbnb, I think we're going to deliver a huge amount of growth in years to come. And so there's really three things that we're doing. The first thing is transparent pricing with all-in pricing display. In Europe, in many countries around the world, we actually do show total price. But in the United States, the convention for travel companies is to show a low base rate. And then when you get to checkout, there's additional fees. But we spend a lot of time listening to our guests and hosts, and we've heard from our guests. It's not that a lot of them want to be able to see the total price up front. And so we spent a bunch of time in December. We rolled out total pricing, includes all fees before taxes. Since we've rolled it out, the impact on our bookings has been neutral. Now I know there was a lot of there was a lot of speculation around what happens you show up on pricing, but I think that the response has been very positive. And we chose a very specific implementation. And the implementation we chose was a price toggle where you can turn it on or off. The basic idea is give people the control of how they want to see prices, but also the act of turning the toggle on helps people understand why our prices are changing and why they might be displayed different than competitors. So again, the impact has been neutral on bookings in the short run, but I actually think the impact on bookings in the long run is going to be very positive because it's just a better experience and it gives people more control. The second thing is we are now prioritizing better value listings in search results. So in other words, we're going to take the total price into account when we're prioritizing bookings. And then the third thing we're going to be doing is we're building new tools, pricing tools for hosts so that they understand the final price that they're showing to guests. One of the things we learned when we talk to hosts is they don't always know the final price guests are paying. And if they did, they'd modulate some of the fees. I think in the short run, it may have some modest impacts on ADR, but in the long run, I think what it's going to do is drive a lot more demand to Airbnb. I don't know if Dave, you want to add anything or take the second question.
No, I think you hit on all the key points on ADR. We're not anticipating a significant decrease in ADR as a result of these pricing tools. We just want to make sure that we're being transparent and helping hosts make sure that they're setting prices that are appropriate for their listings. So I think that on the nights and experiences trends, we're finally beginning to reach a point where the year-over-year comparisons are much more consistent. And so I think 2023 won't look exactly like 2022, but it's a much better guide than kind of historic years. So we are getting back to you'd be able to use year-over-year as a trend line for your forecasting.
Your next question comes from the line of Mario Lu with Barclays. Your line is now open.
Great. Thanks for taking questions. First one's on the listings growth number, the 900,000 year. I was wondering if you could help break down that number further. For example, were most of these listings completely new listings, or were a good portion of it reactivated ones, say in urban areas? Just trying to see how much of this growth is organic versus travel normalizing. Thanks.
Yeah, I mean, the way to think about listings is think about how all listings work. In any given year, we have brand new listings, we have reactivated listings, and then we have deactivated listings, and some combination of each of those three. I'd say that the trends of each of those have been kind of up and to the right. In other words, I think we're showing improvement in fewer deactivations and strengthening of our new activations. And so the sum total of each of those is all contributing towards our growth. But I don't have any other more specific breakout to give to you. I mean, I think maybe the only other highlight I would give is it wasn't in just kind of one region. Like we were seeing broad-based growth of listings around the world, and then even by listing type. It was like one of the earlier questions about how is listing growth around urban. Again, and urban was one of the accelerating areas. So you've seen really nice growth in the urban where that comes back. It just leads back to this marketplace dynamic that we have for Airbnb, which is we both work hard to get listings proactively on our own and get them more organically where there's demand. And where there's not demand, that's also where you'll see deactivations or fewer listing growth. It tends to be self-healing over time.
Great. Thanks, Dave. And the second one's on the lead time for bookings. In your outlook, you mentioned Europeans were booking summer travel earlier this year. So any commentary you can provide on just globally how lead times look thus far versus pre-pandemic, and any puts and takes to consider when thinking about if the 20% room night growth is sustainable for the rest of the year? Thanks.
Yeah, we're really pleased with the European lead times coming up. Europeans will tend to book their summer travel here in the beginning of the year, and to see them booking even earlier on Airbnb relative to our historic rates has been really great to see. Just, I think, shows the optimism that they have for kind of travel this summer. And then broad-based, we are just seeing a slightly longer lead time more generally across Airbnb overall. So again, I just think that shows a nice optimism for people feeling confident that they can book for their summer travel season. So I think I don't have much more to say than that.
All right, thank you.
Thanks.
As a reminder, please limit yourself to one question. Your next question comes from the line of Justin Post with Bank of America. Your line is now open.
Great. I think you give it in a K, but can you give us the mix of Asia in 22? I don't know if you can now. And then secondly, how do you think about the Asia recovery and China cross-border impacting results over the next 12 months? Thanks.
Yeah, in the next 12 months, Asia is still recovering, right? Asia's still been down versus 2019, but they were the fastest kind of growing region in the fourth quarter. So we think it's pretty optimistic about the opportunity. And as Brian even mentioned about China, like the long-term outlook for example, Chinese outbound travelers is something that we feel very bullish on for over the long term. And in terms of the fourth quarter, APAC was at 12% of the business in the fourth quarter.
Thank you.
And I'll just say that I think that Asia Pacific is a huge growth area for us going forward, and it's been a little bit of a slower recovery. And I think the reason why is Asia is historically more of a cross-border market. A lot of people in Asia basically travel across countries. They don't have as big of a domestic market in any of these countries for the most part, and that's just been a slower recovery. But I think the one thing we've seen is that just means probably more pent-up demand, and Asia indexes even higher on Gen Z travelers, which is a strong suit of Airbnb. So we're really bullish over the next few years on Asia.
Great, thank you.
Your next question comes from the line of Lloyd Walmsley with UBS. Your line is now open.
Hi, thanks for taking the question. This is Chris on for Lloyd. Just can you start by helping us think about the range of outcomes for ADRs in the 1Q 23 guide? I guess as we kind of lay out your guidance saying that take rates would be very similar to 1Q 22 levels and get you to, say, 20.7 billion potentially of gross bookings in 1Q 23, and you assume maybe a slight decel on room nights, I could get to a situation where ADRs are potentially flat to better. I guess you're talking to ADRs being down slightly on a year-over-year basis. I guess what would need to happen here for ADRs to be flat to better on a year-over-year basis in 1Q?
Well, to be flat to better would be if there's stronger overall just pricing, and if the mix came in differently. For example, maybe urban didn't come in quite as strong as, or cross-border, Latin America, Asia didn't come in quite as strong. So a lot of our ADR forecast for Q1 comes from the anticipated continued growth of urban, cross-border, and regional mix. And that's why we're forecasting it down for, just down slightly year over year. The implied take rate, it should be directionally the same as last year, maybe not precisely the same, but I think you look back at 2022 and it'll be a good guide for your take rate.
Okay, got it. And just maybe one quick follow-up question on the product side, as you guys are talking about really kind of expansion opportunities. How should we be thinking about hotel within that? Or should we be thinking about more of the expansion opportunities being related to the core business and experiences in 23?
Chris, I would just say, all the above. I think hotels are important ways to fill a network gaps. I think people come to Airbnb because we have something unique they can't get anywhere else, but we also have a huge amount of traffic. And so we want to make sure people come to Airbnb, they don't leave without finding something. So I think you can think about our product a few ways. Number one, our core business has a huge amount of growth ahead of us. And so we just want to first perfect the core experience by making it easier to find the right Airbnb, providing better service each step of the way, and providing better value. Next, we have a lot of emerging use cases. Those emerging use cases are longer stays, obviously, which is more than a fifth of our nights booked. We also have experiences that we're really focused on and continuing to fill out our network gaps. And then finally, beyond just all of those are obviously new products and services over the horizon. So we kind of have a very balanced portfolio of all of the above.
Okay, got it. Thank you.
Your next question comes from the line of Kevin Kopelman with Cowen. Your line is now open.
Great, thanks a lot. So quick one, given you have $10 billion in cash on the balance sheet and generated $3 billion in cash flow last year, not including the funds held on behalf of guests, can you just give us an update how you're thinking about capital allocation and share repurchases? And do you see a potential for repurchases to go beyond offsetting stock comp? Thanks.
Yeah, I'm really pleased with our cash position, right? We ended with $9.6 billion of cash on the balance sheet at the end of the year. That is after buying back $1.5 billion in stock. We have $500 million left on the existing repurchase approval, and we anticipate that will be executing earlier in the year. But clearly we're also still in growth mode. Like, we are using this balance sheet to make sure that we can invest in growth for the business in the future. Clearly keep enough cash for potential M&A opportunities which could exist. And then, to the extent that we can return stock, cash to shareholders through share repurchases, that'll be our primary vehicle you'd anticipate this year. We're going to have about $1 billion of stock-based compensation. We'll at least be offsetting that through share repurchases. But I don't have anything more to say beyond that at this time, but we'll continue to evaluate what the appropriate amount of cash is to keep and how much we should continue to return to shareholders. But remember, we are still heavily in growth mode. We want to be able to invest in the long-term growth of this business.
Thanks, Dave.
Your next question comes from the line of Stephen Ju with Credit Suisse. Your line is now open.
Okay, great. Thank you. So can you
talk about the typical behavior from the new hosts when they're onboarded? They start making only a small number of days available, and as time goes on and they get more comfortable with hosting, they maybe make more time slots available throughout the course of the year, because it seems like we're all completely preoccupied with the total host number, because honestly, that's the only number that's disclosed. But I'm wondering if the aggregate availability growth has historically been a number that's been much higher than the property or host growth. Thanks.
Yeah, hey Stephen, I can start. The general trend we see is that most people come to Airbnb with kind of more casual intent to host occasionally. Sometimes people come to Airbnb to host on a one-off basis. For example, this past weekend in Phoenix, we saw a really big surge of new listings for Super Bowl. What we notice is that over time, hosts generally increase the number of days available, and they tend to get more productive every year. And so more and more nights get booked on a single listing. And then we also see a number of hosts add a second, third, or fourth listing, depending upon what markets they're in. So the general idea is that hosts get more productive. They eventually book more nights. Their ADR typically goes up as they accumulate more reviews. One of the things we recommend new hosts do is when they don't have reviews to start a little bit more affordably. And then as they accumulate great reviews, they can command a little bit higher kind of market pricing. And so those are the general trends we see. A general uptick in ADR is to get more reviews and build a reputation. They add more nights, and then occasionally you'll see some people add additional listings, depending upon the kind of segment they're in.
Thank you.
Your next question comes from the line of Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. I just wanted to circle back on your comments on EBITDA margins for 23. You talked about maintaining margins with the variable cost efficiencies kind of being the offset to lower ADRs. Just walk us through a little bit more on those cost efficiencies that you're thinking about. And then kind of related, how should we think about marketing spending? Sounds like you're going to shift more of the brand into 1Q. Is that just driven by a pull forward in bookings or more of just a shift in your strategy? Thanks.
Yeah, the way we've anticipated our EBITDA margins for this year is that one of the headwinds is this anticipated ADR decline that we talked about earlier on the call, and that the way in which we are going to be able to offset the margin impact of those declines will be through fixed cost discipline. We're going to continue to grow, but we're going to grow modestly. So think of our headcount growth being in the 2, 3, 4% range. So we'll keep having very good fixed cost discipline. We've already, I'll address marketing in a minute, but because we've already addressed a lot of the marketing reductions, but we're just seeing strong improvements in our variable cost reductions as well. Everything from community support costs, cost of payments costs, infrastructure costs. All those areas are just important and ongoing efforts for us to drive profitability. As I mentioned earlier, we're still in heavy growth mode. I am not in profit maximization mode. I have a long list of things that we can invest in to drive further profitability, but I know that I can also afford, with our headcount growth, profitability improvements that can offset the ADR declines, and that's what we'll be investing in this year. And then, we can keep working on the other variable cost improvements over time. And then in terms of marketing, we've had the major step change reduction in our marketing expense. That was actually a strategic change all the way back in 2019 that's proven to be incredibly effective from 2020 all the way through 2022. And what we'd see in 2023 is that marketing costs as a percentage of revenue for the full year will be about the same as what it was in 2022. But what we are doing is shifting some of the timing. We're just getting even earlier in the year to make sure that we're getting our message out to guests all around the world so that they're ready to kind of make their bookings for kind of peak summer travel season, which is in the summer. And so I think it's just we're getting more efficient and effective at the timing, and we think bringing forward a little bit more marketing into Q1 is a more effective use of our dollars.
Thank you.
Your next question comes from the line of Nick Jones with JMP Securities. Your line is now open.
Great. Thanks for taking the questions. Can I go back to kind of the Airbnb friendly apartments? What does it look like to get property managers on board with this? And I guess how much of the apartments that they're managing start to get unlocked? And I guess what kind of runway do you see in these key markets to add on kind of meaningfully more property managers? Thanks.
Yeah, I can start, Nick. So yeah, I mean, this new program is something that we developed because actually we started getting a lot of inbound from real estate developers, and they started, we started saying, if we made our buildings Airbnb friendly, would it make the building more appealing, especially to young people that are moving to markets, certain cities? And so we did a partnership. We started with working with Greystar, Equity Residential, over 10 other companies. And we've launched, we have 175 buildings in like Houston, Phoenix, Jacksonville. And the vast majority of these units are kind of, we expect if they were put on Airbnb, they would be a typical kind of ADR. They're usually one bedrooms and studios. The tenants sign a sublease to a fixed number of days a year they can rent, typically less than 180 days. So the whole idea is these are people's primary homes and they rent them when they're gone. And, I think we're going to get a lot of demand because there's a lot of benefits to landlords. Number one, a landlord gets visibility control around who's doing what in their building. Number two, they get a lot of free demand of people that want to lease their apartments. And three, they get a cut on the Airbnb, on the commission. So based on what we're seeing, there's been a lot of positive word of mouth. Many REITs and developers are engaging with Airbnb. We think we're going to be able to send a lot of traffic to them. And so I think this is a program that's going to grow quite a lot. And I also think why it's strategic to us, beyond all the incremental apartments that it unlocks, is we're now developing relationships with many of the biggest landlords in the United States. And if that happens, I think you're going to see leases generally being more friendly to Airbnb.
Great, thank you.
Your next question comes from the line of Bernie McTernan with Needham. Your line is now open.
Great. Thank you for taking the questions. On margin, so two impacts on ADRs, the mix shift and the pricing. It sounds like mix shift is contemplated in that flat EBITDA margin guide for 23, but can you still achieve flat EBITDA margins if that pricing benefit does come out modestly of ADRs? And as a follow-up, just if there's an estimate for how much FX weighed on EBITDA margins in 22, that'd be helpful. Thank you.
Yeah, on the two impacts, I mean, as you said, large forecast that we have for ADR moderation is due to the mix shift. Clearly, we want to make sure that we are giving tools to hosts to price effectively so that we have great value. It will be, time will tell how much change we'll see in ADR from those overall changes. I do have, a fair amount of levers, as I said, over time that I can pull in order to continue to improve the cost efficiency. And if ADRs come down more, then I may need to pull a few more levers, but I feel confident we can deliver our EBITDA margin neutral in the face of whatever ADR headwinds that we see this year. So I think that's the main end piece. And then your second question again?
Oh, just if there was an estimate for how much FX weighed on EBITDA margins this year, given the differential between where revenues are generated and where the costs are in the U.S.
Maybe we can follow up offline on that. I mean, it was a material, probably several $100 million, but we'd have to give you the, maybe we'll work offline on the specific calculation.
Understood. Thank you.
Great. Thanks for the call, Bernie.
Your next question comes from the line of Tom White with D.A. Davidson. Your line is now open.
Great. Thanks for taking my question. Any color or metrics you guys can provide on how cohorts of guests that you acquired during the height of the pandemic have been performing over the last several months, kind of relative to customers acquired pre-pandemic? I'm just curious whether, it looks like there might be any meaningful differences when it comes to, frequency, spend levels, repeat rates, anything like that.
No, the actual frequencies, take rate, spend rates have actually been very consistent with kind of pre-COVID acquired guests. So we feel really good about the new guests coming on and having them look very similar to historic guests. And so very consistent.
Great, thank you.
Your next question comes from the line of Deepak Mathivanan with Wolfe Research. Your line is now open.
Right. Great. Thanks for taking the questions. Just a couple ones. First, It's nice to see the supply growth, but can you talk about trends on the utilization side? I know you don't look at occupancy in a traditional sense, but any color on how the product initiatives like, the changing the search experience or I'm flexible from 2022 is kind of helping with, utilization or occupancy on the platform? And then second question, mix of long-term stays remains stable near 20%. How should we think about that for 2023? Is that a potential opportunity and an area of focus for 2023? What sort of product initiatives can you do to kind of take that mix higher, given that it, obviously helps with the marketplace balance? Thank you so much.
Yeah, thanks, Deepak. On the supply growth, I think the best measure to look at is you just look at the growth in supply that we had versus 2019, that, we grew at 26% and our nights and experiences book grew 24%, kind of largely in line. We're not seeing any major shifts in overall kind of utilization rate that give us any concern. We feel like we continue to keep in aggregate this nice balance of growing supply and growing demand, and we want to keep that relative balance. As I mentioned earlier in the call, if one gets out of whack too much, then either the hosts aren't happy or the guests aren't happy. But I'm very pleased with the way in which we've been able to keep that balanced. And then in terms of long-term stays, if you actually rewind the tape all the way back to pre-COVID time, Q1 of 2019, our long-term stays were about 13% of nights. By the end of the year, it was maybe 16% of nights. So think 13 to 16. Last year was kind of 19 to 21 or so. 21% obviously in the fourth quarter. So it's been elevated and fairly stable. I think what we see in Q1 this year is that we continue to see really strong growth in short-term stays, and short-term stays kind of outpacing our growth a little bit versus long-term stays here in the first quarter. So I anticipate it coming down just a little bit here in the first quarter on a mixed basis, but it's largely just driven by, the short-term acceleration that we're seeing, and it's still remaining significantly elevated over 2019 rates.
Got it. Thank you so much. That makes sense.
Thank you.
This concludes our Q&A session for today. I turn the call back over to Brian for closing remarks.
All right, everyone. Well, thank you for joining us today. To recap, we had another record year in 2022. Revenue and adjusted EBITDA were both record highs, and free cash flow was $3.4 billion. I'm really proud of these results. And before I go, I just want to say, how proud I am of our team. If you think about what this team has been through the last 3 years, initially losing 80% of our business, kind of rebuilding the company from the ground up, and now just becoming a much more focused, disciplined company, this is a lot of momentum inside the company. And looking forward, we're already seeing some really strong demand in Q1. Consumer confidence to travel remains really high. I think part of that is no matter what happens in the world, people want to travel, and for many people, the office is now Zoom, the mall is now Amazon, the theater is now Netflix. And so travel is going to become a very important way that people experience the world this year. And so therefore, this is going to be an exciting year for Airbnb and for traveling all around the world. So with that, thank you all, and we'll talk to you next quarter.
This concludes today's conference call. Thank you for attending. You may now disconnect.